If you enjoyed this podcast, please subscribe, like, and share so we can find others like yourself. BitcoinProsperityPodcast.com. Welcome to the Bitcoin Prosperity Podcast with your host Gordon, that's me, and Ferris from CoinCompass.com, enabling you to safely buy and securely store your Bitcoins. All resources are in the show notes and description, including our full disclaimer. Visit BitcoinProsperityPodcast.com to subscribe and discover other free content.
Hello, everyone. Welcome to another episode of Bitcoin Prosperity Podcast. And this edition, we're looking at Bitcoin and macro markets. So it is Sunday, the 26th of April, 21:33 UTC time. I am in New Zealand, so it's 9:30 a.m. Monday morning here. So the main thing I'm looking at this week across the markets, what I'm actually noticing in a lot of charts is gaps. So economically, the wheels have stopped spinning. Essentially, the world that we live under is one based on consumption and the repetitive behavior of such. So if you're not going out and spending, you're not fueling what is a debt-based economy. So that is where we are today, is that the hamster in the wheel is no longer running, which is why we've had banks basically sending people money, which is very little to make a difference. And at some point that needs to get paid back. Risk assets don't seem to have received the message. We'll look at some charts, and if you looked at charts, you'd think that things were looking pretty well around the world. And are we chasing gaps? So we'll go to the Wilshire 4,500. Now, in our last series, we explained that this Wilshire 4,500 used to be called the Wilshire 5,000. It's basically made up of 5,000 listed companies around the world. They had to change it to 4,500 because we have fewer listed companies now, obviously with the big conglomerates taking over smaller ones and fewer new companies coming on the market. So that in itself has never been a good sign of economic growth when you have fewer companies applying to be privatized and to be listed on exchanges. So we saw here, we had the top at just above 1625. And then we had this huge correction, 20% correction, obviously with the onset of COVID-19. And you see we've got this big arrow here. So we've got this gap, big open gap here, 1313 to 1360. So we've got a gap there in the Wilshire 4,500 and another one even higher just below all-time highs. So the saying goes, gaps get filled. Doesn't mean they're going to get filled this week, month, or even year, or even decade. But there is a saying in markets that gaps get filled, and actually has been proven that gaps do get filled. We're seeing the same thing if we move across to the NASDAQ. So this is the makeup of the tech-based, 100 tech-based industries, which has been the darling of this huge bull run. So if I zoom out, you see this pattern here, this trend line, this green trend line since the bottom of 2016. So 2015, 2016 was the Eurozone crisis, and then we had quantitative easing introduced from those banks, and we've just seen this trend line hold since then. So a 4-year trend line is something I would pay attention to. That's a nice long trend line, and it's been hit 4 times since. And then we've got the upper here. So it would be crazy to think we'd be going to all-time highs from here. There is this gap, though, at 9,400, where potentially is what we're going after. And if you look at last week's candle, that bottomed and closed near the top. So that's not a reversal candle. That if you looked at that chart there, you would think we are going higher and not lower, despite what all the news is telling us. So are we chasing this open gap here in the NASDAQ as well? Okay, if I move to the Russell, now the Russell's an interesting one because we've got this gap as well in the Russell, but it's much lower. The gap in the NASDAQ and the Wilshire were way up here near all-time highs. The gap in the Russell is a smaller gap, and it's nowhere near the all-time highs, and that's interesting. So to me, if the Russell fills this gap here, and then the Russell rolls over, that could be a leading indicator to the rest of the market. So again, they don't have to get filled. They don't, and if they do, it could be a long way away. But right now, to me, this just looks like markets are risk on. And it could just be that the fact that, yep, we're printing so much money that we think the Fed has got your back. And here the Russell is key level down here at 947. We got very close to touching that recently at 962. So there's a level of support there that has held up. And that's a long way away from breaking. When we get closer to that, then we can analyze it. But for now, markets are acting risk on. It doesn't make sense to me. I don't think they should be. But that's where we are. We're chasing gaps. Do you want to learn how to safely buy and securely store your Bitcoins? CoinCompass.com is running a free 2-hour webinar on Sunday, 31st of May. To register and for more details, visit CoinCompass.com/webinar. Okay, we move across to oil, and oil obviously was a big story for last week. I recommend you listen to the Macro Voices podcast. They go into detail explaining oil in far more detail than I actually can. But yeah, not signs of an economic recovery. And we spoke about this last time. When oil is down, it basically means that people are not traveling. Truck drivers are not transporting goods. Oil is the world's most traded commodity. So if no one wants it, that tells you, hey, we are not in good times when people do not want oil. So, yeah, you'd spend a couple of hours onto itself just looking at the price of oil. The chart we're looking at now, the US oil, that could see some huge changes just this week alone. So another interesting one I want to look at is the VIX. So the VIX is the volatility index. So we're seeing here the Friday in the VIX was a huge down day, which basically would have meant that people are not anticipating any risk for the next 30 days. And we're hitting this key level here at $36, where it bounced off, huge wick down there back on the 24th of March. We break below there, and again, the VIX could be chasing a gap down here at the $18 to $20 level. So you could say we are looking at potentially 1 to 2 weeks of risk on, where the VIX is chasing this gap here. And we had the NASDAQ, the Wilshire, also chasing gaps as well, and the Russell. So these are the risky assets chasing gaps. So we could be looking at a potential risk-on rally here, which, as I said, makes absolutely no sense to me, but that is what the chart is telling me. Now, if we look at gold has done very well, and this is a weekly chart, which is going from, this is a 10-year chart looking at on a weekly basis. So this green dotted line here, that was the ceiling for gold from 2013 all the way to this year, and we broke through that, with abandon. It was really nice breakout, and we came back. You expect it to come back and test this level. We didn't. We tested. We came above it. We've got a new support level at 1450. So gold is hitting some resistance up ahead. So we've got this level of resistance just below 1800. Now, having said that, that resistance is 7 years old. So markets have memories. How long those memories last? Anything at 5 years or later is a pretty distant memory. I would expect gold to pull back at 1800, round number. We've got that yellow resistance line. And then we've got the previous all-time highs at 1920. So again, if you bought gold in 2012, would you have held on this long expecting it to come back? I don't know. So yeah, there is a resistance there, but it could be weak because it's old resistance. It's 7 years old. So interesting to see what gold does. But again, if gold is going up, and gold had a big week last week, why is gold going up as equities are going up as well? Normally, they're meant to be anti-correlated. You buy gold because things are not well in the world. You don't buy gold as a risk-on asset. But that is correlated to the next chart that we will look at, which is yields. So this is a daily chart of the 30-year bond. So as a reminder, if the yield is going down in a bond, that basically means that the bond prices are going up. So you are buying bonds because they're seen as a safe haven asset like gold. This is a US 30 bond. So 30 years from now, you expect the US government to still be there, the US economy to still be running. That's basically what you're gambling on, the US government. And we've had this level, we hit this level here at 1.17 on US 30 yields. So that's, to me, looking at all these charts, everything looks pretty scattered. I like gold, even though it's got some resistance up ahead. I wouldn't be adding to my gold positions now if I had some. This, to me, looks like if you wanted to trade something this week, the US 30, buying US 30 treasuries would be the least risky, least volatile trade. That's what I'm looking at. Even though I think equities are going higher, I wouldn't chase them, to be honest. It just doesn't make sense to me, and it looks far too risky. But yeah, the US 30 here, breaking below this level here, and you could be heading way back down to these all-time low yields of 0.8%. And that seems obscene, but you got to remember that in Europe and even in Japan, you've got yields at negative. So you're paying the government to hold your money for you. Topsy-turvy world we live in. Euro US. So Euro US had a nice head and shoulders. This is a weekly chart lost in 2018. We then had this channel that was going down, and these last couple of weeks has been way too volatile. You don't want to be trading this. I just look at this and go, that is just way too erratic. There's no trend there. I believe the US dollar is going higher, but I'm not going to trade on a belief. That chart is just telling me to stay away. And the other thing I want to talk about is the reason that gold is going up and interest rates are coming down is this chart here. So this is assets of the Federal Reserve. So basically the Federal Reserve is just buying stuff. And to do so, they're spending US tax dollars to do so. So US debt is going up from 4 trillion to 6.5 trillion inside of a month. And that is obscene. That is just a complete disrespect for US taxpayers, for future generations. And we've done this in the past. So yeah, there is no exit strategy here. We are actually going to be interviewing Mark Yusko on this very podcast. And this is something I want to ask him about. What is the exit strategy? How in the world are you going to get the world out? How are you going to get yourselves out of this much debt? Because debt implies the future generation is going to pay it. So Bitcoin. So this is my concern for Bitcoin. We are going up. We had a good week. This low I was never convinced by, simply because high volume on a down day. These candles here do not look like bottoming candles to me. They're indecision candles. But we're grinding higher. The problem is we are grinding higher into this downward trend here, that gold line. So, and yeah, the other concern is that it's basically been really strongly correlated to the NASDAQ. So Bitcoin is not being treated as a safe haven asset. This red line I've just introduced, that's the NASDAQ. So if the NASDAQ is chasing these open gaps, Bitcoin is probably just following suit. So we could see the NASDAQ hit those gaps as Bitcoin hits this downward trend line. So again, if you had Bitcoin, which you should, I would just hold it. I would expect a reversal at this trend line, this downward trend line here. And then we could be revisiting these lows. But yeah, at this stage, I'm not trading Bitcoin. I just, we do recommend dollar cost averaging. And, as we always say with Bitcoin, you just buy it for the long term. It is not correlated to a safe haven asset at the moment. It should be, but there's still a huge misunderstanding out there as to what Bitcoin is. So that's why Bitcoin is just not behaving in a manner that it should be as a safe haven asset. It is just still a misunderstood currency. Bitcoin looks like it is behaving in a similar manner as the NASDAQ in that we are chasing these gaps in the NASDAQ, and Bitcoin is chasing potentially this downward trend line at 9,300 about. So we could see that once Bitcoin gets to about 9,300, that could coincide with all those gaps we're looking at get filled. And then potentially we're looking at a reversal in Bitcoin and in those equities reversing. To me, that's the possible scenario playing out here, is that you've got low volume, so lower volume here in this rally. So not that many people believe in this rally. And I think when we've had these huge rallies, it's just had huge selling. I mean, you look at that volume there and volume there. So I think that's what's going on. I think we're going to see, a rally in Bitcoin, hit this trend line. That's going to coincide with the gaps in those equity markets that we're looking at. So these next few weeks will basically determine, is Bitcoin and indices going to all-time highs, or are we setting up for another rollover in all of them? So as with everything, just live long and hodl.
Thanks for watching or listening. Please visit coincompass.com/free to register to our socials and discover other free content. Subscribing, liking, and following helps this content remain ad-free. Until next time.